What's up, guys? JD here, and on today's show, your brain is going to sizzle. I know mine is. I'm talking to Isaac Olowolafe, who is one of the most impressive entrepreneurs I know. And I don't say that lightly because I know a lot of entrepreneurs. This guy, as a teenager, bought his very first apartment for no money down, bought it for free, ended up making a profit of $75,000 on it, plus many years of cash flow, and then did that exact same thing over and over and over again with no money down. And we're going to get into exactly how he did it. It is a crazy story. This guy is an artist and a scientist when it comes to making money in real estate. Then he built a brokerage, he built an asset management firm, wealth management, and then he put all that aside and started a VC fund, and now he's on his way to his second VC fund with tens of millions of dollars under management, investing into some of the biggest technology companies today. This is a wild story, and we get into the weeds on this. You're going to want to sit down and take notes because we get into specifics, into numbers. This is my favorite kind of conversation to have. Under the collar, mud and dirt under the fingernails, because we are getting into the weeds. That's coming up in just a second. My name is Jon Davids. If you like the show, go ahead and smash the subscribe button on Apple, Spotify, YouTube. Tell your friends. That's how we grow. If you want my best stuff to your inbox, go to jondavids.com, get on the newsletter. And now, let's get to my conversation with Isaac Olowolafe. So Isaac, you and I met a few years ago through a mutual friend, the legendary Sonny Mocha.
Yes.
And I got to tell you, when he first introduced you to me before I met you, like this is how he described you to me. I want you to kind of put yourself in my head. So he was like, there's this guy. He started with real estate, then he went into insurance, then he went into wealth management. And now he's doing super well. And I just had this vision in my head of like, I don't know, like a 67-year-old gray-haired dude who had been at this for 40 years. And then I met you and I was like, what the hell's going on here? Who are you? So can you just tell for our listeners and viewers here, like give us the 1 minute nutshell of kind of how you started and where you are today?
Excellent. Yeah, no, again, serial entrepreneur. I just clocked 20 years in the business of entrepreneurship. Started when I was 20 years old and really started off as a real estate broker and then wanted more challenges. So became a real estate developer, builder. Our first project was a 9-story building. And while doing our second project, 23 townhouses, saw the impact of technology in Canada and innovation. So through that, launched an angel fund, Dreammaker Ventures, and dabbled into the tech space. And then through that, launched the first institutionally backed venture fund for Black founders. It's been a
Okay, you
crazy
just
20
flew
years.
through like multi-billion-dollar ideas in record time. So let's go to the very beginning here. Okay, I think you told me this story, but I can't remember it that well. When you first started, like, first of all, were you born into money? Like, do you come from a rich family?
No, my parents, we came here when I was 4 years old, lived in the Jane and Finch area, then moved to Martin Grove and Albion. And then we were fortunate. I was playing soccer at that time. My grade 8 coach, convinced my parents, hey, you guys should move to Woodbridge if you want to get scouted. If your son wants to get scouted for soccer, soccer didn't pan out, but, we moved to Woodbridge and really got exposed to the other part of Woodbridge outside of soccer, which is entrepreneurship, construction, real estate development.
Okay, so how old were you when you first got exposed to real estate?
I'll probably say around 17, both from, high school. And then my dad was just getting into becoming a real estate broker as well, too. So, and, they always had the entrepreneurship mindset. My mom was a vet doctor. And my dad, again, got into real estate, first studied engineering, and then got into real estate.
So he gets into real estate. You're 16 years old. At some point there, I don't know if it was right away or later on, you started to accumulate apartments. And I think you, instead of taking cash as commission, you would take apartments as commission. Am I right on that?
Correct. Yeah. So got my real estate license at 21. So at that time, I got into University of Toronto. Obviously, my parents focused on school. So got into U of T, was taking economics, and then got my real estate license, was working a midnight shift at UPS, and then took the capital from UPS, whatever I was making, and then just started to structure deals. The first deal was like $125,000 condo at Kipling and Steeles because that's all I could afford at that time. Then another condo in Malvern. And then my first pre-construction unit was right at Front Spadina, 325 Front Street. And I bought it right after it was built. And I saw what it was originally bought for. And I'm like, oh, that's interesting. Only been a year. Why am I paying that much more? And that's when the whole pre-construction bug got into my head. And then we sort of I changed my sort of strategy on how I was buying real estate and went full forced into the pre-construction boom that went on for almost 10 plus years.
So you said the first unit you bought was $125,000, and that was not pre-construction. That was an apartment that existed. And so how did you structure that first deal? Like, where did you get the 125 from?
Yeah, so that one back then there was zero down, 40-year amortization, and I was a real estate agent. So my commission from the transaction was what I used for the closing costs. So it was a zero down transaction. Scotiabank 6.75%. Still remember it. 40-year amortization. Needed about 2,500 for closing costs, which is about the same amount that I got for commission. So I was able to get into the real estate game that way.
So when you say commission, you were the buyer. So
Correct. Yes.
commission. So it was your own commission on your own
Correct. Yeah,
transaction.
yes. I was representing myself. Yeah, as a real estate agent. I said, so I'm going to buy real estate. I might as well represent myself on the deal since I was running the numbers myself as well.
So you had this job. You said you're working the midnight shift at UPS, but you didn't actually even need that UPS money because the first transaction you had no money down. It was all
Correct.
commission.
Correct.
All
Exactly.
right. So you do that, and let's just stick to that first deal for a second. You seem to know your numbers really well. So how did that pan out? You put 125,000 in. What did that cash flow, and what did you make on that?
Yeah, so I held that property for about 8 years, and then I think by the time it sold, prices started to go up. So it sold around 200,000. So really, it's a property that was really zero down, levered 100%, yielded out just under $80,000. So it was a great transaction, great experience. Um, Also got into the property management through that property, obviously managing a tenant, finding a tenant. At that time, we were using Kijiji, throw it on Kijiji, and then screen through all the tenants. At that time, tenants paid, and it was it was easier to manage tenants unlike right now. But it was no, it was a good learning process. Like I said, in between studying for my real estate license and midnight shift at UPS and trying to get over 60% or 70% at U of T economics classes was a busy period.
Okay, so just to close the loop on that, so you bought it for 125,000. You ended up selling it 8 years later for 200,000, but you were also getting rent money throughout those 8 years. So someone was paying you rent, and were you making a profit every
Yeah,
month on that
so
rent?
making about 200, 250 a month, plus the mortgage was being paid down as well too. So really, like again, it was the most ideal transaction where making net profit on the cash flow because we were managing it. I was managing it myself, paying down the mortgage. The tenant was paying down the mortgage, and there was appreciation as well too.
All right, so that was transaction number one, and then you talked about three or four of those? Did they all kind of follow that same formula?
Yeah, so they all follow that same formula until I got my first property downtown, and that's when the aha moment with the pre-construction game started.
So you realize that there was a much better arbitrage to be had on pre-construction. So can you talk about what you saw then? What were the unit economics like? What could you buy and then make on those transactions?
Yeah, absolutely. So that's when, again, using what I was studying at economics, I said, okay, it's all about fundamentals. Like, what are the fundamentals of Toronto? So you got to think back. This was 16 years ago now. So I'm like, the fundamentals were okay. The government is immigration, big topic now, but 16 years ago saw that boom, immigration. The government's talking about infrastructure that they're going to be invested into the city, into transit. So that was a big indicator as well too. Institutional indicator, all the universities. So that was driving good jobs and all that kind of stuff. And then I started to look at what are the resale price points. So then when I saw resale at that time, condos were hitting now 200, 250. Then I went and saw pre-construction launches. But at that time, I was only 2 years in the game, so I didn't really know the developers, the Tridells, the Phantom developments, the Daniels. So I did what most people would do, wait in line until you get a shot. So I remember there's one site I was first in line after waiting almost 3 nights. And Sonny will tell you a story. Guys were going out clubbing and all that. I was just there waiting. We had a sign up sheet, and more people would just come until it was opening night. And first walked in, secured at that time maybe 6 or 7 units at an average of 150 to 175, because the market value at that time, a finished product, was 250. So we're almost buying at wholesale, and you compare it based on the market retail price, but closing in 3 to 4 years, and you put down 5% down. Plus, I was the real estate agent, and you're getting 4% commission as well too. So I'll tell them that, you know what, I don't need no commission. Still staying at home, so I really don't need the money. So let's roll that commission towards my down payment. So really, I was putting 1% down per unit, and they were about 50 to 75,000 below the market value based on a finished product, and we got 10 of them.
Okay,
So,
to pause
yeah,
here. This is like so much gold here. So just to back up, the scene you set, you are literally waiting outside an office for 3 days. You said to get to physically standing in line to sign a sheet that says I want to buy 10 of these units.
correct.
So each unit, you're doing an arbitrage on an arbitrage, because not only are you able to buy a unit that's going to be worth, I think you said 250,000, you're buying it for 150 or 175, but also the commission that you make on that as the agent, because you're representing yourself,
Yeah.
actually goes to fund the down payment. So these are literally costing you nothing.
Nothing. Yeah, yeah. Just time,
This is
just time. And but the key was really understanding the floor plan, understanding the project, and understanding the floor type. So I'll give you an example. So we were securing, 500 square feet, 550 square feet, one plus dens, and making sure the den was big enough to be converted to a junior 2 bedroom. And then we'll look at what's a junior 2 bedroom selling for, because we wanted to get into the lowest product type per category. So a junior 1 bedroom will be a studio that could convert into a junior 1 bedroom. So we bought it below the category, but by adding a sliding door, we were now the lowest of the second category. So that's how we were playing out all our models. So then we'll see a full 2 bedroom is selling, that 700 square feet is selling, let's say, for 300,000. We would buy a one plus den for 200,000, and then insert a full close-in door for maybe $10,000. So now, once we put in the marketplace, we actually have a two bedroom unit.
Jesus. Okay. Well, okay. That third arbitrage that you just mentioned, which is buying I think you described it as the highest unit of the second. How did you say it?
Yeah. So the lowest unit type per category.
The lowest
So
unit type per category. And where did you even get that idea? Was that something you figured out later, or you had that on day one?
So that went through just trial and error, right? Because again, I would buy it. First, we're going, what's the lowest price? So then we'll buy the lowest price unit, but that's not always the best valued unit, which then started to change our philosophy of how we invest. We don't invest based on price, we invest based on value. So regardless of where the location was, if it made sense valued wise, what is the closest to transit, the closest to the university, the closest to the mall that's being a multi-billion-dollar renovation, closest to a luxury condo, right? So we were looking at what the value was, not necessarily the price, and then what could that unit be utilized for. So that one plus den was more than a 1 bedroom, but it brought us to another category if we put in a sliding door.
Right. It makes so much sense. I think you just hit on such an important point, which is it's not about the cheapest; it's the best value. It's the same thing, for example, in the e-commerce or online advertising world, which is people say, "Well, I want to spend the least amount of money to advertise." No, you want to spend the most amount of money to advertise as long as the ROI is there. If you
Correct.
can get three x whatever you're spending, or 5x whatever you're spending, you should spend $1 million if you can, as long as the numbers hold up.
Correct.
there's no cap as long as you keep making money. All right. So this is okay. So that's great. So let's fast forward here. So you have this operating model. How far do you scale that? This whole let's buy pre-construction. How many units did you buy with that philosophy?
Yeah, so we did over 40 projects, thousands of units, and more people sort of jumped on board after lining up for probably 5 or 6 sites and being, one of the youngest. I was first in line and just coming up with a different style that a lot of the developers didn't see years before. A lot of them reached out and said, "Okay, Isaac, you know what? You don't have to stay outside for this launch. Let's sit down and see how we could work with you as back then they used to call the VVIP and the VIP. Everyone became a VIP at the end of the day, but really some had relationships. So some of these developers will call us in, call me in and my team and say, okay, look, we're about to launch in a month. You obviously have an understanding of floor plans and you have an idea of what you're looking for. So here's the grid, lay out what you want on this floor. So then I'll sort of draw it out and say, okay, you know what? Give me this one plus den, give me a junior 1 bedroom there, give me a couple studios, give me this 2 plus den, which becomes a 3 bedroom. And then I say, okay, we're going to take 30 units. The best project where we did that was Jade Waterfront, but that one we just went all out with the 1 beds. That was right on Lakeshore and Park Lawn. That's where the Lakeshore and Park Lawn boom was just about to happen. South Etobicoke, Mimico go is not too far. We knew there were signs the Christie factory was going to shut down, multi-billion dollar developments. Omni is doing their development sites. Empire is there too. And all their prices, finished products, was easily 100 to 200,000 more. So this was an easy one, right? We sat down at that time with Hunter Milborn, great mentor in the game. And then Henry from Phantom sat down and said, okay, you guys have about 380 units. How do we move 70 of them? And this is how we want to move it, right? So we structured the deal. And yeah, that was a very successful project for everyone.
Okay, I want to hit on two things. You said the thing you described at the beginning was a framework for how you buy, how you arbitrage, how you finance through commission. So I get all that. Who are you selling all these to? Because you have, whatever it is, dozens and dozens of apartments. Do you now have a buyer list that's adding up? Do you have others that are doing the sales for you?
Correct. So by that time, then we launched our real estate brokerage, Dreammaker Realty, scale is up to about 25, 30 licensed agents. And really, we were providing access to those that had no access to this type of model and no access to units, right? Because like anything else, real estate, especially if you want to get a deal, it's all about relationships, it's all about getting access. I was fortunate, I got access to it. And there was a lot of people, whether it be my age, from my community, that didn't have access to those units. So we would package it, and everyone got it one for one for whatever we got access to. They got access.
Okay, and you keep saying we and our. Who's actually working in the business on day one, and then as you were scaling, like before you had the 25 agents, who was doing this?
A lot of it was me, myself, and I.
It
But
was
no,
you. I love the royal we because I say we also when I'm referring to myself.
no, but I had some close friends that were part of it. That we were bouncing a lot of ideas together. Obviously, my dad was there too, but more so on the resale side. And really, again, it was just sort of a lone soldier going into the space. Again, fortunate to have those that saw somewhat the vision. It was there's really nothing to replicate. Like when that condo boom started, like right after the '08, '06 crash, prices were low. I remember in Liberty Village, Five Hannah specifically, a site, they were giving away 2-story condo towns for 149 with 5% down. And the problem is there was a lot of gimmicks in marketing in terms of buy this and get a car and all that kind of stuff. But we were like, okay, how do we not get distracted by all the gimmicks? Let's narrow down to where the fundamental values are. And the
Yeah,
fundamental
because
value,
you're not a retail buyer who cares about getting a free set of AirPods. Like you want to
correct.
make money on the transaction. Your product is this pre-construction, which you're going to flip. And by the way, there's a lot of like, it's a flex, obviously, and I'm the same. We say we when I'm referring to myself. In the early days, it was just me. But there's actually, I think, even a bigger flex in the fact that you're running this whole thing yourself. The fact, like, I'm super impressed by someone who runs $100 million hedge fund with like one person. Like that actually is even more impressive to me than having an army of people, because it's like, no, dude, I can manage $1 billion. What's the problem with that? So I love the fact that you're doing this kind of on your own. So what I'm curious about is, at what point here, so does this model that you're running break at some point, or are you doing the same thing today, or did this have a lifespan?
Well, the interesting thing is like once we did like 30 projects, I went to Bay Street and said, "Look, guys, let's launch a fund that strictly buys pre-construction." Right? So this was, before the Gray Brooks. These were before some of the other funds that entered the sort of equity space, condo space, pre-construction space.
What year is this?
So this would have been, again, like probably 13, 14 years ago. Yeah. So
Okay,
yeah,
so we're like 2010, 2011
2010.
here.
Yeah, 2010, 2011. Yeah, yeah, exactly. Right. So it was like people didn't really see the scalability of pre-construction. And then the reality is it went on a run for another decade. Right. So it went on a run for a decade. When the fund aspect didn't work, that's when I said, okay, how do I challenge myself more? And then that's when, 6 years, 7 years into doing pre-construction, we jumped into the development space and said, let's see
Why
if we
didn't the
could do.
fund work? So you went to folks on Bay Street and you said, here's what I'm doing, here's my portfolio, here's my returns, and they just said, no, we don't like this asset class.
Yeah, they don't like the asset class. We don't think condos has any legs. Prices are about to drop. We didn't. Yeah, like no one believed that the condo boom was going to go for another decade, right? So, and they didn't believe on the fact that you could buy for 200,000, and by the time it's built, it's worth 500,000. And and you raise the deposits, and then you assign it in the marketplace, which is what people were doing individually. I just wanted to do it as an institutional scale model.
How big did you get, like, before you tried to raise the fund? How big were you? How many units did you have at that point?
Yeah, so like I said, we probably moved like close to 700 plus units pre-construction. We were working with, like I said, close to 30 different development sites. We had a solid 6 or 7 closed developers that we will meet with, and we had the ability to scale this more and really, and again, it's just understanding the model. Okay, there was the Liberty Village growth. Then there was the Queen West. Then there was the King West. Then there was Canary District. Right around the time Pan Am Games was about to launch, so we were picking up all these different communities that had their blocks of buildings that they were about to build, and then we'll compare it with the retail price, and then see what's that gap, what's the commission, how do we throw that into a model, and then put points on the raise, right? And then convert it into, let's say we hold it for 5 years and it becomes a rental REIT. So there was a lot of things that was going through my mind. But I think maybe, again, at that time, it was just not something that was an asset class that was packaged
Yeah, I
at that.
get it.
Yeah.
So did you ever run into funding problems? I mean, you said you did this 700 times. Was there ever a point where you're like, I'm out of money? Or were you just constantly doing this with leverage so you didn't need more money?
Yeah, we were always turning it. Like we were always turning it. We were always selling it because there's always demand for units to buy, because we didn't have to sell at the market value once it's built. But we had units in different buildings, and then the rental game started to boom as well too. Rental prices started to go up. Rates were still low. So like there was a period for like 7 years, 8 years. It was just perfect. Rents were going up, prices were going up, rates are low. There wasn't that many people that caught wind of that model. And then even when they caught wind of that model, they didn't have the full understanding of the floor plates, what units works, what units doesn't work, what locations work, what locations don't work.
You were so far ahead on the unfair amount of knowledge that you had. Like, forget about the arbitrage and the business model, the fact that you were an agent, so you were using your commission to pay for this. You also just knew everything about the market, the areas. Were you spending like were you just spending hours and hours every day studying neighborhoods and economic trends? Like, was this your focus?
Yeah, that was my focus, and really, again, looking at really the fundamentals of things, and again, that speaks to how we were able to do the Yorkdale, our first development site, at a time when people thought, "Why do you want to launch a condo across a Yorkdale Mall?"
So tell
I
me
thought,
about that. That's about the time that I met you. You were building that. So how did that transaction come up and what was it?
yeah, so I think with some of my development friends, I started to plant the seed that look, guys, my brokerage is still going to be selling pre-construction unit, but I want to challenge myself more. I want to see if I could stretch my limits. So that at that time I was turning 28, 29. Said, look, I'm going to jump into the development space, right? And they're like, okay, let us know if you find a site. We'll let you know if we find something. And then one of them reached out and said, look, we have a site. It's way too small for us. It's only zero point 0.7 of an acre. It's in an area in North York. It's on a major street near the highway, close to a mall that you probably know, Yorkdale Mall. I'm like, okay, let me see it. I go there. I look around the area. I look at the mall. I research. I see Oxford's about to put in $1 billion or so into expanding the mall. I see the province is about to expand the subway. I see there's going to launch the first digital hospital at 401 in Kiel. It's 15 minutes from the airport. I see on Dufferin and Lawrence, they already started to do those development sites by another major developer. I said, look, 88 units, it's 9 stories, 3 levels underground, 4 townhouses. What's the worst that could happen? I know from a sales point of view, we could sell all 88 units. Now I just have to put together a real solid team from the construction side, engineering side, development side, legal side, and that's what I love doing. I love putting together teams, putting together pieces, and that's what we did, and we did what people thought we weren't able to do, and we developed and built a 9 story building as my first project in 4 years.
Okay, did anything go majorly wrong there, or did it basically go according to plan?
From a first project, I've never renovated even a house. I think it went as perfect as a development site could
So
go.
you
No,
have no. By the way, you're not a handyman. You don't paint. You don't fix toilets. Like, that's not your game at all.
that's not my game. That's not my game. I'm a big dreamer. Put pieces together, put specialists together, and literally that's what I did. Whether it was that first presentation to Terrion saying this is what we want to do, all the no's from different lenders that they ask, okay, which family are you from? Da da da. Da. What's your first? What project have you done before? And this that. But what was very good, again, we speak about the tech ecosystem, the real estate development ecosystem, was really having the support from developers that I sold a lot of units for that almost gave like a letter of recommendations. Like, yeah, no, this guy's good. He understands his stuff. He understands the sales aspect, and if he brings in the right construction team and all that kind of stuff, and right guys sort of doing that expertise, we have believed that he'll be able to execute this.
Can you share the numbers from that first Yorkdale project?
Well, the interesting thing, so like units at that time were selling around 450 to 500,000 for a 1 plus den to a 2 bedroom. People were buying it at an average of 350 to 450. So everyone that bought made capital when they sold. We did 88 units. We structured it in a way where we were able to keep 50% of the building.
Wait a
Um,
minute. So pause for a second, because I just want to make sure I get what you're saying. So it's 88 units, but when you built it, or maybe even before you poured the foundation, you were already selling the units. So you were getting financing from the buyers who were then going to flip the units to somebody else, presumably, or maybe keep them from themselves. That's how this worked.
Correct. Yeah. So for any new developments, you always have to sell 65, 70% pre-sold. So we had that done. We didn't have to do any sales center. actually we leveraged the Joey's restaurant across the street. That became sort of
I
our
remember. So it's
remember?
funny. I remember Sonny would tell me he was at that Joey's all the time
Yeah,
because he was
yeah.
just selling your
Yeah,
units.
we were moving a lot of units at Joey's. They liked us there, right? Because we were again moving a lot of units, and
So what was the total amount of money that you needed? Like, what did the whole thing cost?
so I'll say just under 35. So the land was just I think just
$35
under
million. dollars.
yeah, the land was just under 6 million. Like when you put things in perspective of what that would have cost right now, that's why I like to do a 9-story building. um, like the infrastructure, the underground is strong enough to do 14, 15 stories. So there's a lot of cost that went into the underground at that time. I think I was involved in 2 strikes. I'm trying to remember. Yeah, I think it was 1 or 2 strikes. Um, I'm not a guy that loves the winter, but during that period, I got to love the winter because we were excavating the underground during the winter. I'll never forget. I had my hood on, and the snow is just falling down, and there's a hole, and the shoring was being done. It was a wild experience. Like I think during that period, I said I got my PhD in developments, right?
Of course, and you
Yeah,
got
like
paid handsomely for it.
yeah, it was and really the exposure, like, and I wanted to do more, right? And I wanted to build more, and I wanted to take advantage of sort of the area that I was in, the marketplace that we're in, how we're coming into the market from someone that understood the economics piece, someone that understood the development piece, the sales piece, the marketing piece, the property management piece. So as we were probably halfway into that, we started another site in Pickering, 23 townhouses, right? And
Wow.
we started the 23 townhouses that was under construction.
How
And
many of these have you done now? How many developments have you built yourself now?
yeah, so we built the 9-story building. We built 23 townhouses. We built 6 townhouses at Bayview and York Mills. That was a special one because I always liked the Bridle Path Bayview area. So that was right at Bayview and York Mills, one Heathcote. Then because we were doing a lot of Airbnb, and there's that whole Airbnb boom. And I realized that was not going to be a boom that will last because of the clash with condo corps. And we were seeing it firsthand because we actually managed the condo corp on our first one. So we found an old industrial building by the airport. Again, value. It was an old industrial building at the end of the road beside a truck parking spot. And we were able to go into the city, develop it, navigate. This was pre-COVID when you could go and talk with the city, talk with the planners, talk and build a relationship and show your vision. And we turned this old industrial building into a boutique hotel called Dream Suites at YYZ. And we stopped doing
Yes.
Airbnb, and then we moved into there. And then all of a sudden we got into the hotel game.
Okay. What year was that in Dream Suites YYZ?
So
Was
that
that
was so
22?
we finished that literally 4 months before COVID.
Okay,
I
so
still vividly remember. So 2019,
2019.
remember we had an event with a few artists, entertainers, DJ Envy, Cardi, and all that group came. That was December of 2019. Excited to launch it spring of 2020, and then COVID hit.
Yeah. So what did you have a lot of I'm trying to understand like I understand you had to hire some people obviously when you start to do this development stuff, then you need to really have a team. It can't just be you.
Correct.
At what point here, though, like just in your own personal financial situation, because you're obviously putting, when you're in real estate, everything you have is in buildings, it's in bricks and foundation. At what point here are you actually financially free, or are you still just totally tied up in real estate
Yeah,
today?
still totally tied up because like for us the big goal was to bring on an institutional equity partner, right? We felt like for us to really scale this and get to a point where we could go from 9-story building to doing, 30-story buildings to doing multiple projects, we had to bring in that institutional partner. But to bring that institutional partner, we had to show sort of a track record of what we've done. So that
Have you done
first,
that yet? Or are you still looking for an institutional partner?
so well, we pivoted, right? Because once COVID hit, all institutional partners, all institutional capital sort of paused for about 12 months until the market went back up for about 18 months during COVID, or 2 years.
Were you
And then,
worried? So when COVID hits and you're like in the prime here, what
yeah,
happens to you? Describe March 2020 for me.
it was
NBA shuts down, world
it,
shuts down. What
yeah.
what happened in your brain?
Oh, it was crazy. It was survival mode. It was like, what do you do with your development sites? And as we know, and the province talks about it all the time, the red tape of developments, of approvals, getting approvals. So, like for us, we're a mom and pop development company, right? We're not a third generation development company, second generation development company. So we're a mom and pop development company that, to develop a site, takes time. So if something should take 4 years, ends up taking 6 years to develop, and you're burning a lot of cash, that could bankrupt a development company, or any company really. Then to add in the layer of COVID, at the same time we're about to launch our hotel, which was supposed to be the cash flow to fund our development sites. It was like two hits at one point, right? So that's when really it's okay, figuring out, okay, what do we keep, what do we sell, how do we
Did you have
position
to
ourselves.
liquidate a lot at that point, or were you able to make it
And
through?
it was the worst time to liquidate, right? Because it was COVID, right? And or you had tenants, and at that time there was, you can't sort of kick out tenants, so tenants didn't really have the incentive to pay their rent during that period. So we were dealing with units where rents weren't being paid. We had development sites that were just being held, because now I couldn't go to the city, talk about my project, talk about what we want to do, couldn't present it. So now it's over the phone, and if you don't cash them at the right time, then you got to wait another week. Then you
How
got
bad did it get? So in the height of COVID, what was the lowest point, and then how did you move up from there?
It was scary. Like it got to a point where, like, we had to sell units. We had to figure out to restructure sites, sell sites. We literally had to figure out how to survive that whole period. And then at the same time, we started to do our luxury custom homes, right? So it was weird. Like, we started to we disposed of our luxury custom homes right at like fall of 2020, because we're like, look, people aren't don't want to buy condo units. Like, why would they want to buy custom homes? So we're disposing of our custom homes, and then literally 10 months later, there's a massive custom home boom. So we had a few custom lots that we were still doing. So it was just a weird period. And then all of a sudden, like, we were getting more calls on our custom home side, because we, a year prior to that, started to dabble in on sort of the luxury custom homes because of what we did at Bayview and York Mills. We got some exposure on the luxury side than what we were doing in Kleinburg, and then it led to King City, and then Nobleton. So we accidentally got into the luxury custom homes, and we were building, nice custom homes at a very affordable price, for families. And again, we were sort of a turnkey model. So we sort of pivoted to the custom homes. 18 months into it, the hotel started to go up and running. So that's going well. We found another opportunity to do another hotel. So while all of this is happening in 2020, 2021, obviously we know that's when a lot of the institutions now start to talk about, diversity, inclusion, and all these different things. And that's where, our shoulders were being tapped because of what we've been doing in the marketplace, and sort of the mission that we had about, affordable housing, giving back, inclusiveness within different spaces where it lacks. And through that, it allowed us to really pivot into the affordable housing side, which we're now working with a few developers on that side, and then sort of pivoted to some of the VC space too.
Okay, I want to talk about affordable housing. I want to talk about VC. Before we get there, though, I just have one question. How many? Because I started the talk talking about the fact that you kind of built layer upon layer upon layer. How many revenue stream companies did you have at this point? Because it feel like you had obviously real estate development. You were buying. You had an asset management firm. You also had a brokerage. Like, how many streams of revenue did you have coming in?
Yeah. So again, the real estate brokerage was in the peak of it was doing very well. So that was one. Then property management, we're managing between units and building probably close to 400 plus units. Then we were doing a bunch of buying and selling. So through assignment deals. Then we were doing a little bit of consultant work. That's when we just started doing some consulting work for those that were trying to get into the space and really wanted to get our wealth of information. Because I believe 20 years was really like 40 years of experience built in, right? Because very hands on all of it, right? Which is good and bad. The good thing is that like anything from end to end for real estate, totally understand it, the processes. So now when we go into joint ventures, we're able to work with larger developers that are looking for a partner that could execute on smaller jobs that they may not want to execute on the
So
construction. Yeah.
So even though you developing real estate is a cash intensive business, you still had other lines of revenue coming in that were adjacent that are actually paying the bills, cash flows coming. So you're not cash strapped, even though you're in a cash intensive space.
Correct. And that was the reason why we started to dabble into sort of the boutique hotel and really wanted to build that portfolio. Just like a lot of developers that came in through, they were the contractors. So they had the business of doing the contractor work. Then they became a developer, or they had multiple apartment buildings. Then they became a developer, or they have multiple hotels and now they're redeveloping their hotels and they're now developer builders.
Why did you get into affordable housing? What was that about?
So I saw again where the market was going. Like we're always studying the market, studying what the government is doing, studying where their incentives are, and we saw that and then when the mayor changed, we saw sort of the push from the mayor, the push from the federal side was all around affordable housing, all around affordable rental. So we our first dabble into affordable housing was through our foundation in partnership with Habitat, partnership with Black North, and we launched a homeownership bridge program, right? So that was our first one dabbling. And when we launched that, we saw the massive demand because we were doing all the data outreach. So we did all the outreach to the community for it. So we saw 1,500 people sign up for 200 homes, right? So right off the bat, we were seeing the gaps on that side. Then we started to talk with different municipalities, and all of them said we're looking for ways to provide more affordable rental. And then we saw CMHC pumping more dollars into it. So now we're putting together sort of a model with different partners. This one we're structuring it a little bit different on how do we tackle it, and everyone bringing each of their expertise. We're bringing in the outreach expertise, the relationship. COVID is gone, city's back open. I could do what I do best: go present, explain the vision, what we're trying to do, figure out the site, bring in the site, and then bring in our construction partners, and now bring in our lending partners and execute on it.
And is that the biggest focus you have now, the affordable housing side?
No, actually, no. So like the biggest focus now is on the venture side, right? So really unlocking that venture side. We have a
Okay, man.
partner.
All right, we got. I got to do a setup here. So
Yeah.
for the listeners, everything we're talking about here is real estate. Isaac is also an active VC investor, so tech VC. So let's go there now. What was your intro to the world of venture capital?
Yeah, again, it was so just to cut off on the real estate side. So a partner runs it day to day now, and I'm more so there on the advisory side, all the years of experience. And then yeah, the VC side, the VC bug hit me probably about 7, 8, close to 10 years ago. Again, as we were building the condos, always giving back, speaking at different universities, and then was speaking at Ryerson, now TMU. We gave a gift there, the Isaac Olowolafe Digital Media Lab in the Student Learning Center. So we gave the gift there, and was there to speak with some students. And then I saw, right beside it, the launch pad. I'm like, oh, this is nice, interesting. Founders pitching their company, and then a few of them came to me, told me what they were doing. And how they were raising capital, and if I knew anything about raising capital. So this is about 10 years ago. Okay, like you're raising capital for your business. Like, yeah, we're doing like a pre-seed and a seed. Would he be interested? I'm like, in what? And doing what? Or so then, and
I love how this is totally foreign to you.
so now I'm like,
Seeing
okay,
what?
so like, what do I do when don't understand something? Read up on it, right? So read up on it, did some research on it. I'm like, oh wow, like okay, this is another fundamental factor that I actually was now using within the real estate set. That another fundamental arm was that Toronto is becoming Silicon Valley North, right? Which is another indirect impact for real estate. Why it's going to grow, which it did help with the growth of it, especially in Toronto and Waterloo, et cetera. Right. So started with that, then did a little angel investing, and then really saw the gap within the marketplace for underrepresented founders. Right. So at that time, then I went to the DMZ, which already had a great incubator. At that time, I think they were like 4 or 5 years into it. They just celebrated their 10 year a couple of years
And the
ago.
DMZ is an incubator associated with
Ryerson
TMU.
/ TMU, yeah,
Got it.
with TMU, and they're the number one tech incubator out of any university in Canada. So I went there, met with President Mohammed and Abdullah, and said, "Look, let's structure a deal where we'll create more opportunity for Black founders." And we created the first Black tech incubator called the Black Innovation Fellowship. Was only really to impact 10 founders a year. Now it's grown to impact thousands of founders online and in present, and it's grown to probably the largest Black tech incubator in the country, and become a model for other universities to launch. U of T and other different universities have launched it. But the benefit of doing that was it caught the eyes of other institutions and see it like now you've created an incubator where you're able to mentor, collaborate with Black founders that are trying to scale their business, but they can't scale without access to capital,
And
especially
were you
institutions.
actually so this partnership that you had, were you actually putting your own capital? Was that the start of your fund, or did your fund not start until later?
Yeah, the fund didn't start yet, so we raised capital. We're fortunate to collaborate with BMO, Shopify, the Canadian Women's Foundation, and we raised $1 million and kicked that off, and it showed great success right off the bat. And then around 2021 was when the whole aspect of okay, let's launch a venture fund. There seems to be a demand for it, but how big is the demand? So again, that's where it's telling the story, showing that look, we know where the access is. We see the founders every day. So originally it was supposed to be a $10 million fund. It got oversubscribed. It ended up being $25 million.
And was that you going out to institutions just telling the story?
Correct. Yeah. So it was me, and that at that time brought on a business partner, Liz, who was originally based from Montreal, and really was me pitching BDC, EDC, Scotiabank, RBC, Van City, CDPQ, and telling them, look, this is an untapped market, and that everyone is pouring capital over here, and there are thousands of entrepreneurs over here. The stats are there. Pre-COVID was less than 1% going to Black founders. During COVID, it went up to about 1 to 1.5. Now it's less than what it was pre-COVID. I see that as an opportunity, and I think institutions that's been backing us see that as an opportunity. And we were fortunate to get Vicky funded, fortunate to get pension money, and we've invested now in 14 companies. But what's been interesting is we've been able to invest in companies that first no one saw, then introduce them to the larger tech ecosystem, and we've now gotten follow-on investments from the larger tech ecosystem, right? And now we're sort of being positioned as, oh, Isaac, have you seen this company? They'll pass it to us, or we're now sharing portfolio companies and really changing the narrative when it comes to the tech to the tech space. So just to put things in perspective, we've seen close to 1,300 companies in less than 3 years, invested in 14, and easily 20 to 25% of those companies were VC backable. So that just shows the demand.
Okay, and so you have this fund now. Is it fund one still, or do you have a second fund?
Yeah, so Fund 1 is done. We're about to launch Fund 2, $50 million size. And now we're going to go from pre-seed to Series A, and we're going to focus on larger check sizes and larger ownership.
A lot of people who have a background in real estate investing and real estate development, and I know because my father-in-law does just that, they can't wrap their head around venture investing because it is so different. You're not talking about I'll put 25%, I'll put $1 million in for 25%. You're talking I'll put $1 million in for 0.5% and I'm going to be diluted down, and the fundamentals are different. You're also not playing a game where there's a likelihood of success. The successes here are the outliers, and the
Correct.
successes here are not the averages. How do you mesh your brain around these two concepts?
Yeah, I think the biggest thing is there's just a love for entrepreneurship, right? There's a love for entrepreneurship and the love for having an impact and chasing value. So this goes back to the whole aspect of chasing value. And right now we're chasing valued companies at reasonably priced um, investment opportunity because of the lack of capital going to it. And we've seen it with some of the companies that we invested into that remove sort of the spectrum of who is leading it. It would have been at a much higher valuation. But this is where the growth opportunity is, right? Like anything else, right? Until it becomes sort of mainstream, people don't put massive value on it. But we're changing that, right? We've collaborated with institutions on the incubator side. We've collaborated with institutions on the fundraising side, so they're seeing firsthand where their capital is going and the faces of the founders that are growing these great companies from cybersecurity to prop tech to fintech to health tech to consumers to art CRM system and we're and to also I think the biggest piece is when you tie in what's happening from an immigration point of view, and you're tying where there's a lot of entrepreneurs coming in from other parts of the world that are migrating here, and we now have provided them a soft landing through our incubator, and then for those that are scaling, the ability to get first access to our fund just puts us in a very unique opportunity.
Where do you see yourself? How old are you today?
41.
41. Okay. Where do you see yourself? I mean, you're so young for the game you're playing. People don't achieve your level of success until their 50s, 60s. How long do you see yourself doing this for? Do you have a third chapter in your head already, or could you see yourself doing this for the next 30 years?
No, I love this. I think really is to scale multiple funds on the BKR side. I think probably scale it as much until the mainstream really see the opportunity that we believe we're fully taking advantage of and first mover advantage. But we don't only want to be the first mover advantage, but the biggest in that thesis, right? We believe it's a big like we're investing, and sometimes it's hard to say, what's the size of the market? When companies come and speak about, invest in my company because it's the size of the market. So when you're raising a fund and this is your thesis, your specific thesis, it may seem small, but then it's large when you look at, the fact that we're investing in companies that are doing the same type of companies across the board from other communities, but they just lack access to capital, right? And really, right, that is the opportunity. So we've sort of helped to de-risk an industry, a space that is very risky. As you said, you invest in 10 companies, maybe one thrive. But if you're investing in 10 companies out of 14, 1,500 companies that you've seen, and these are companies at a lower valuation just because of the narrative of where the background is from, and they're building the companies in a city that is thriving and has access to capital, and they're scaling to the States and they're scaling to Africa, they're scaling to other parts of the world. There's upside there.
There's a ton of upside, and as you were talking, I actually realized such a theme, which is that what you were doing in the earliest days, buying those units, figuring out how to buy the highest tier of the second category, and then add a door so you can make an extra
Value.
20,000.
It's all
You're
about
doing the
value.
same thing here. You're finding these founders who are just undervalued, but they're just as valuable. The upside is the same, but you
We
can
know
get in at a
we
better
know what it
price.
takes to put them to the next category.
That's it.
right? And the biggest difference is we couldn't scale our pre-construction. Why? Institutional capital didn't see it as a value at that point. We're fortunate right from day one, we got some strategic institutional capital that saw the value. And that's why we're already seeing these results, which is not typical in the VC world, right? Where you see those results right away in terms of the positioning of the brand and what we're doing. We have our fellowship. We're in our third fellowship now, where we're doing 6 to 9 month cohorts for individuals that want to get into investment management, right? So we're changing the whole landscape when it comes to the VC space, and we're not doing it in silo. We're doing it with the ecosystem.
Isaac, so inspiring. And every time I talk to you, my mind is just like sizzling because I got so many ideas, and it's a great pleasure, man. Where can people find more about you and the companies?
Yeah, so BKR Capital is where to find me. Isaac at bkrcapital.ca. And again, we're just excited for Fund 2. We're excited about the impact that we're going to have. And you're going to see these companies there. You're going to see them. If you need cybersecurity, there's Protexa, co-working space, there's Loft, fintech space, there's Wovio, in the health tech space. Yeah, we're in the art. If you love art, you got to take a look at Arterno, based out of LA, but Canadian founder, right? So there's a lot of great entrepreneurs, and we're shedding light on them.
Awesome, man. Thanks so much.
Thank you very much.